For Morningstar, I'm Jeremy Glazer. There's a number of economic factors right now that are beneficial to the consumer, but are really weighing on corporate results. I'm here with Bob Johnson, our Director of Economic Analysis, to make sense of it all. Bob, thanks for joining me.
It's great to be here today.
So we've seen, as we kind of get into earnings season here, a bit of a bifurcation where consumers still seem pretty happy, but management teams are mainly downbeat. Let's look at some of these factors and see who they're helping. The first being, of course, the strong dollar. What are you seeing in terms of the dollar impact on earnings so far?
Well, it's been a little bit bigger than people have been thinking. I mean, we've been talking the dollar for a long time, depending on which metric you use, is 12 to 18% higher than it was just 6 to 12 months ago. So it's been a big change in the dollar, and it's really come home to roost. I mean, just to pick one example, this week Procter & Gamble reported earnings, which were particularly disappointing. And one of the things they cited was the currency. And they talked about in the year ahead that with currency all wrapped in, it was that revenues were going to be down 6% and profits 12% because of just currency effects. So it's certainly a big number, and a lot of S&P 500 companies have a lot of revenues in Europe. Even though there's a lot of utilities in the S&P 500, or not utilities, but a lot of stable businesses in the S&P 500 that don't have a European exposure, overall, it's something like 13% of S&P 500 revenues come out of Europe. So that's a pretty big number, and certainly with the currency going the wrong way, it's having some effects when we translate those back to the U.S. And that's even before we consider the products themselves probably aren't as price competitive as they once were.
Consumers are certainly enjoying gasoline under $2 a gallon in many places, but maybe some of the corporations that are selling the gas and that are in the energy sector aren't. How are you seeing the impact of lower oil prices on businesses?
Well, just first of all, to your question about the energy part of it, it's been a huge impact. I mean, and we're talking about now in the fourth quarter, we're likely to see no growth year over year in S&P 500 earnings. And the reason that is because the earnings sectors have been such a large negative, and even still a little bit of a negative surprise, even after people have started to factor things in. So clearly it's had a very direct effect, and we're going to have one of the poorest improvements in earnings that we've seen this entire recovery, entirely just in the energy sector, besides the kind of knock-on effects that we can talk about in some of the other business sectors. So there's a direct effect there. And then we saw this week on kind of carryover effects is on a company like Caterpillar. They've been hit every bad way that you can. I mean, they've always been, kind of had a presence in the mining market, and that's been slowing for some time. And now oil and gas, which is kind of an engine of growth, that has been slowing. And then on today's call, or on this week's call, they're even talking about the fact, well, yeah, the mining equipment and the oil stuff's down, but guess what? The towns that are next to all of that equipment and all of those sites, well, they're not building houses as much. The construction has slowed down. And so our regular construction equipment, not even oil and gas related equipment, isn't selling all that well either. So you've had a lot, and then they've got currency too. So I mean, talk about getting hit in all directions. Perfect situation there for them.
Now, Caterpillar is not the only manufacturer that's being hurt. When you look at the entire U.S. manufacturing sector, are there signs that things like low energy prices and a stronger dollar are really starting to take their toll?
They are starting to. This week we had the durable goods report, and again, it came on the day of some bad earnings, and it really put together one of the worst stock market days we've seen for a while. And certainly the durable goods order report on the headline basis was down over 3%. Obviously, Boeing Airliners was part of that, and we always say you got to toss that out. They're volatile from month to month. They got an 8-year backlog, so they're going to keep producing what they can produce, and what the orders are don't make any difference, at least in the short term. And so even stripping those out, though, the durable goods orders were down over 1%, and this is like the third month where we've been flat or down in durable goods. So we're already beginning to see that. And what's really interesting is you can't lay your hands on one easy category to say, okay, how big is this sector and what's it doing to the numbers, because the pipelines are in the tubular steel part of the business, or fabricated metals part of the business. The software tools that help find the oil are in computers. The houses in North Dakota that are near the facilities are in the housing category. So it's not an easy calculation. And I think we're starting to see some of those relationships in a more painful way than many people thought.
So we are seeing these painful things for businesses, but a lot of them, as we mentioned, were positive for consumers.
Yep.
What have we seen in terms of consumer strength? Will they be able to kind of spend their way to the point where the economy can kind of muddle through some of these other problems?
I think that's probably going to happen. I think this week we had I don't like the consumer confidence numbers, but we did have the numbers from the conference board, and they were the best we've seen in the entire recovery. We were up well over 100 on that metric. Really blew away expectations. Again, it's probably more a reflection than gasoline prices were down than what they actually may end up spending, but it was a barn burner of a number. The second number that I think it's really of interest and speaks to the strength of the consumer is kind of the Apple earnings this week. I mean, the number of phones that they sold was 10 to 20% higher than what anybody had thought. So it was a wildly successful holiday season for them, and it's clear that where a lot of consumer dollars ended up was in iPhones. And I think one of the things we had worried a little bit is that retail sales looked a little funky, a little weak in the latest period. And now it's pretty clear that probably some of that went into the iPhone market instead, which gets rated in consumer services, not necessarily in the goods part of the GDP calculation. So it's very interesting that maybe that explains why the retail sales report looks so funky at the beginning of the month.
So it sounds like we could have these two countervailing forces with us for some time. Absolutely. And I talk again and again about it, that we've had this disconnect between the U.S. economy and the U.S. consumer. With the consumer 70% of the U.S. economy, that's clearly what drives things here. And S&P 500 companies. I mean, we went through kind of 3 or 4 years where the U.S. consumer and the U.S. economy did okay and limped along, and S&P earnings went through the roof. And now we're starting to see, unfortunately, a little bit of a payback time where S&P earnings are getting shellacked, and the U.S. economy and the consumer are doing a little bit better. Bob, thanks for your insights on this today.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.